G'day folks, welcome back to another update for high-grade copper and US crude oil. Now they're both continuing to consolidate since our last video. We're going to include some back testing, and don't forget to hit that like and subscribe button, but also reference the +1 videos, links in the description below, which take a deeper dive into some of the trading strategies that we talk about in today's video and every day. In terms of the outlook, copper looks poised for strength due to structural demands such as EVs, renewables and infrastructure, and tightening supply, making the outlook broadly positive. In contrast, US crude oil faces a more challenging environment with oversupply and weaker demand momentum, pointing to modest or downward pressure unless disrupted by major external events. So we always look at the different time frames first. So looking at high-grade copper on the weekly, the price is still above the moving averages, giving us a slightly bullish momentum on the weekly. However, notice the CCI has broken into that moving average range, which is giving us a cautionary outlook. And you can see there over those few weeks that price has been consolidating, and there's no divergence currently on the weekly that I can see. On the daily, however, again, you can see a very tightening of those moving averages, and that's why I like to use these multiple moving averages. When you start seeing them widen like they did back here, you can see there the price is moving up. And when you start seeing them constrict like this, it just shows consolidation. At the moment, the price is right in the smack bang in the middle of that very narrow moving average range, and the CCI likewise. So again, consolidation at the moment. Now we're going to show the back testing in a moment on going short only. You could have gone pretty much either way, but I'll show you the short positionings primarily on that from that point on. On the 1 hour time frame, again, bullish momentum at the moment. So if you're going short according to the daily, you want to not be trading that. So that's where I've started the back test from this point here. There's no divergence currently. The last divergence we had was this bearish divergence, slightly lower highs versus higher highs on the price, and that pulled back. And if we drew a Fibonacci down to that level, it went down to about the 100% retrace. But even down to that level, just to show you where these Fibonacci's usually land. So at that point there was near the 100% retrace of this price here. And then here, if we took the Fibonacci to that level, you can see there it's broken below that and sort of consolidated in that 61% range for a while before bouncing out. We can't tell where it's going to go from here. We always look at that's why we look at the different time frames to get a better understanding as to where we're going. So again, if you're going short based on the daily from this point, let me go show you the back test now on the hourly. So again, based on the daily, going short. So you would have gone short during that little period and closed out when it hit that, when the price and the moving averages started to turn up. At this point, I like looking at the moving averages as opposed to the price bars. So when you see the moving averages constrict and start turning up, that's where you probably would have closed it out, maybe holding a position open or two. Likewise, also back here, you'll notice we had a bullish divergence versus lower lows on the price, and eventually the price did bounce and hit our minimum target range, that 23-38% range. And then eventually it broke slightly lower and then bounced out of there. So that's our minimum target range on divergence. So you would have gone short again from that little period, close it out when it started going long, and going short again there. And again, notice here, going short in that little period, you had a bearish divergence. You would have closed it out probably at that point there, maybe with a position or two open, and then going short again during that little period, and then closing it out about now. So US crude oil on the weekly is clearly bearish at the moment on the price, but just again notice the CCI is moving to that moving average range, which is a bit of a caution there. But at the moment it looks continuing to the downside at the moment. On the daily, again there's that consolidation of the constricted moving average range. So this could go either way. Another constriction there before it broke it to the lower side. And again, if you're trading on the daily, you want to be going in the direction of the weekly, so taking short trades only. And there's no divergence there. And on the 1 hour time frame, that's just had a break below there, and you would have closed it out. I like closing it out when the CCI breaks into that moving average range. You can see that you would have got out there with a better profit rather than waiting for the price to break into that moving average range necessarily. So if you just want to scalp and take some day trades here, getting out at that point is probably more efficient. Alternatively, and there's no divergence currently on the 1 hour time period. So again, let's look at the back test going short from about the 5th of August on the 1 hour. So taking short trades only. This is the exception when you want to let it run with the moving averages. So again, keeping it zoomed out, going short during that little period, letting the contracts accumulate and average down, so long as the CCI and the price are in a decline, and you would have closed it out probably somewhere when you start seeing the moving average of the price bending up. So you would have got out somewhere there with a small profit. Going short again in that little decline. Again, notice how I'm zooming out very far from 50,000 foot view. I want to be focusing on the moving averages and then closing it out when the CCI and the price start to turn up. Going short again, closing it out, going short, closing out. Now each of these little trades you might take a small loss or a small gain, and you're waiting for the big returns obviously. Avoid trading in that long period obviously. Again, another small short position, avoid trading, another short position there, that would have been a better result, and so on. Always pay attention also, as I said, to the divergence. So if you're going short during this little period, both price and CCI declining, closing it out there when they both started turning up. Here you would have started getting ready for a bearish divergence. The price broke down. That would have been a nice little trade to take, and closing it out when the moving average started to turn up. Another nice little trade. Again, notice another bullish divergence, closing it out there, and so on. And where we are at the moment, as I said, you might have taken a small gain, taking that little trade there with the CCI breaking into that moving average range, or if you wish, let it run so long as the moving averages are still in decline. But again, depends on your strategy. You can scalp. As I said, if you're scalping, take the small gains with the break into the moving average range, or let it run longer and let it accumulate and wait for the moving averages to turn up. To get some share trading ideas, why not subscribe to the Patreon page? See, these are some of the trades we've taken since the 21st of September this year. These are all sold securities. We don't hold any of these at the moment. And since the 21st of September, we've gained 12.48% returns on our trades. So to get access to that bullish share scan we run each week for Patreon subscribers, links in the description below. Hit that like and subscribe button. Thanks for watching, and we'll see you in a future update.